When we take a look at the stock market, at the end of the day, there are only two things that matter.
I'm gonna need two things.
One are valuations, two are earnings. If you take a look at the stock market in 2022, the worst start to the stock market in 50 years, you could see that we've already had the valuation breakdown. Why does this happen? Well, when stocks run too hot and we hit bubble level status, which is not really an exact science, it is based on a lot of macroeconomic factors as well. But investors at large stop feeling comfortable with paying for the valuations that the market is attributing to stocks, especially stocks that haven't proven themselves yet. This is why you see ETFs like ARK and the stocks that live within that horrible ETF draw down much more than stocks like Apple, Microsoft, etc., even though those stocks are down as well. However, we are now on the verge of proving that second major factor as it relates to the stock market, and that is earnings. We've had a few mega caps report, such as Tesla and Netflix, as well as the banks. We've also had Snap, which took an absolute shit after hours, no surprise there. But what is more worrying is the guidance that these companies are offering, or in some cases not offering. The raising of federal interest rates and the monetary tightening that the Fed is currently doing has not yet hit the economy, but the guidance on some of these earnings calls so far have given us a clue on what is to come, and it does not look good. Good news is we still have Microsoft, Apple, Google, Amazon, as well as the mega cap oil companies left to report. But the bad news is if earnings don't impress or we get terrible guidance from some of these mega cap companies, then the market is going to start pricing in that negative growth in the future because the stock market is forward looking and we will be ready for the next leg down. I'm on record as saying that I think we will get to at least the pre-pandemic highs that we achieved in February 2020. Anyway, welcome back to The Traveling Trader. I'm here to break it down all for you. And if you want a video on how to invest, a complete A to Z video on the different derivatives and different stocks that I would invest in, please leave it in the comment section below and I will be happy to make that video for you. But let me know that you have interest in that. Let's get right into it. So as I stated at the outset, the first leg of compression is valuation compression, right? This is where the market starts reevaluating the companies that it has pumped when we reach this bubble. So based on the current macroeconomic landscape, based on everything that is going on, the market is now in the process of reevaluating these companies. And it looks like a lot of these companies from a valuation standpoint have hit a recent floor. However, what is not priced in is what a company is going to do on earnings and what it is going to do in future earnings, which we call guidance. Now, before I get into this, I just want to show you some ways in which you can play earnings, because a lot of people think that you either have to buy calls or puts or buy the stock before earnings, even if you have no clue what's going to happen. An example is the double butterfly spread that we played on Netflix, which is currently up around 30%. And we're basically playing either a major drop in Netflix's price or a major increase in Netflix's price. In this case, Netflix absolutely killed earnings, and they also killed revenue, as well as adding twice the number of subscribers that the market expected. We also played an iron condor on Tesla, which is a neutral strategy, betting that Tesla will remain between 200 and 242.5 by earnings. And we based this off of analysis showing that Tesla rarely beats the expected move on earnings. Anyway, if you want access to all of these trades, our analysis, the group with thousands of traders, if you want access to the options course, the day trading course, if you want access to the Zoom calls with me, sign up. Link is in the description below. Would love to have you. Spots are going up fast for October, as I said in the last video. So make sure to sign up and I'll see you on the other side. Now, the thing about Netflix that wasn't expected was that Netflix said they will no longer provide guidance for paid subscriber numbers for the first quarter of 2023. Or sorry, from the first quarter of 2023 on. Just so you know, companies are not required to give guidance. It's not part of their requirement or their mandate as a public company. But when a company says it's no longer going to provide guidance, it is doing so because obviously it knows that its guidance could actually be affected in the future based on what is going on, not only in their industry, but also in the economy at large. Now, Tesla ended up coming in beating earnings per share, missing slightly on revenue. And although they provided a bird's eye view estimate saying that their long-term guidance should actually remain in place, they are actually on pace to miss their 2022 delivery targets. Elon also said that he thinks eventually the Fed is going to bring interest rates down after they realize that they've gone too high. And if you remember when Nike, along along with some other retailers, announced earnings just last month. They also talked about how Q4 is going to be a difficult season. Now, Snap reported today and it recorded its lowest quarterly sales growth ever. It is stating that there is a significant decline in advertising spending. And here's a shocker. Again, no Q4 guidance was provided. So we are now seeing a trend of companies either not providing Q4 guidance or trying to soften the blow by telling you that they expect not a great Q4. Now, in my view, the problem is just starting because, as I said, the Fed rate hikes, which we've seen 6 so far, I think, right? We've had the quarter basis point rate hike. We've had 50 basis point rate hike. We've had 75, 75, 75. So we've actually seen 5. And the 6th one will be on November 2nd. Because the unemployment data has gone down, which is against what the Fed wants, right? The Fed needs people to stop spending. And because inflation has actually increased in September, and because retail sales spending remains unchanged, meaning people are not spending less, the Fed is going to have to get really aggressive with rate hikes. We are seeing now bets of almost 98% that the Fed will do a 75 to 100 basis point rate hike on November 2nd. And last month, this probability was only at 60%, now almost at 98%. Now, remember, it is not all doom and gloom. We still have some major mega cap companies that can actually move the markets, and Microsoft, Apple, Nvidia, Google, Amazon. We obviously have all the oil companies. We have a big play on energy. We are still in that position and it continues to rise. But we are at a pivotal moment here. This is called a support resistance flip. This level here used to be support. We are now failing to get above it on the weekly chart as it looks like heavy resistance with these tall wicks here. And what the market is basically saying is that if these mega cap companies don't report good earnings and or guidance, then the market will really fail to push past this resistance and continue to make new highs. What's going to happen is the market will likely continue to drop. And I'm eyeing this level here, the pre-COVID highs, for a next major support level. That's around 340 on the SPY, and on the triple Qs, we are looking at a level of around 238. Now, even if we do get good earnings, I don't think that is going to be sustainable for the long term while the Fed is still hiking. The Fed has a very long way to go. Remember, their terminal rate is now estimated at 5%. So they have a lot more hiking to do. We still have quantitative tightening, which could wreak havoc on the market. We have a bond crisis, right? There's a global bond crisis, which I'm not even going to talk about in this video. I'll do a separate video for that. But there's a major issue with liquidity in the bond market. So I don't think that this is unfortunately the end of it. If we do get good earnings, we could see a mini rally, and I will look to take a much bigger short position when those shorts are actually cheap, because right now shorts are really expensive since you'll be shorting from the bottom of the market, or the current bottom of the market, which is the same level from December 2020. But I will be sending out that play in the Academy. So again, if you want access to all of our analysis, hit that link in the description, sign up for a lifetime membership. It is well worth your while, in my opinion. If you want me to create a video on how I would invest from A to Z in a recession, leave it in the comment section below. We'll be happy to do it. Hit that thumbs up if you got anything out of this video. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.